Find the difference between Volcker and Brainerd inflation. What's different with this 7-8% versus a 7-8% when you were certified at Berkeley?
I think the difference is that the inflation that Volcker had to fight built up over a long period of time. And so inflation expectations started to rise pretty significantly. So it's much harder to get rid of the inflation than the inflation we have now. The good news is that the inflation expectations are still relatively well anchored. So that would imply that the Federal Reserve isn't going to have to do quite as much to push inflation back down.
The Fed's plan to shrink the balance sheet by $95 billion a month, as indicated in the recent Fed's meeting minute. This is set to start by May, along with a rate hike by about 50 basis points as they set up for aggressive measures. Now, this is all credible threats. The Fed has to do something to get inflation under control. As we approach all-time new all-time highs not seen since the 70s and early 80s. We are still in a 40-year high territory currently. The cautionary tone comes to the day after two of his colleagues, Governor Ed Brainerd and San Francisco Fed President Mary Daly, also expressed concern over inflation. Guys, this is on purpose. Example, if you accidentally hurt yourself, let's say cooking, you stop immediately and address the situation at hand. If you don't and continue cooking, it's unheard of and dangerous, etc. So you know they are buying time because it's out of their hands. More of a concern than they are going to do something about it. I ran into an interesting video from an old Fed who was interviewed, and his name is Bill Dudley, former president of New York Federal Reserve to be exact. Says that if stocks don't fall soon, the Fed needs to force them. Now pause here. If this happens and the Feds come back and start buying stocks, I am personally out. I'm not playing this game no more. For sure, I'm out of the markets. And this is not financial advice. Seek your own advice, do your due diligence. Think about it. If they control the money now, then the game is confirmed rigged. But I digress. Let's see what's going on, and then at least we got some information to better prepare and move forward. Editor, roll clip, fair use.
Your line in your piece this morning in the lead paragraph, Bill, I think has got everyone's attention, so I'll repeat it for everybody who hasn't heard it so far. To be effective, it'll have to inflict more losses on stock and bond investors than it has so far. Bill, run us through financial conditions and how you gauge financial conditions and why you might believe that stocks are a big part of that.
Well, financial conditions are important in the United States, and Chair Powell has emphasized this in his prepared remarks because that's how monetary policy works. The U.S. economy doesn't really run on short-term interest rates. It really runs on long-term interest rates, and the stock market is also important because a lot of people have exposure to the stock market, and the level of the stock market affects their wealth. So the Fed has said pretty clearly we need to tighten financial conditions to slow the economy down to keep inflation in check. And so far, financial conditions really haven't tightened very much. The stock market is only 4% or so off its high. It's still up very sharply from where it was a couple of years ago. And bond yields, 2.5, 2.6%, are still really low, especially when you adjust for inflation. So in my mind, the Fed hasn't really accomplished much yet. And if financial conditions don't cooperate with the Fed's going to have to do more until financial markets do cooperate.
Bill, talk a little bit about the consequences of this. If stocks are a reflection of sentiment, if they affect the way that people are willing to go out and make purchases based on their household wealth, what does that do to the economy? Are you basically saying that if things continue the way they are, the Fed is going to have to torpedo growth to a potentially recessionary degree?
Well, the Fed right now is, markets are pretty confident in the Fed's program because they have the Fed taking the short-term rates up to about 3%. That causes the economy to slow, and then the Federal Reserve eases policy in 2024 and 2025, and we have a soft landing and live happily ever after. I don't think it's going to be that easy because the markets are so confident in the Fed, the financial conditions are still quite buoyant. If financial conditions are buoyant, that means the Fed has to do more to slow down the economy. Also, a soft landing is very, very hard to achieve when the unemployment rate is so low.
Well, I think what's clear to begin with is that we've seen a big move in guidance and what the markets are expecting in terms of the profile of rate increases, not just in the US, but elsewhere. Bear in mind, in the summer of last year, the markets were pricing no rate rises this year at all in the US. Now they're pricing between 8 and 9. And we think that is necessary given how inflation has picked up and inflation expectations too. And this leaves central banks in a difficult position, having to prioritize slowing inflation, even if it means slower growth. And that feeds through to risk assets by moderating growth and therefore valuations. And that's really, I think, the key driver of what we're seeing in the markets at the moment.
Peter, over the past 24 hours, we have gotten some, I would say, surprisingly hawkish commentary. You heard the comments there from Harker and Lael Brainerd yesterday. Are those the type of comments that warrant the market to pull back 5 to 10% at some point this month?
Well, I think there are a couple of cross currents here. First of all, rising rates, of course, are not helpful to risk assets, particularly if they're slowing growth expectations. And the speed of the adjustment is important. We've just gone through a 2 standard deviation sell-off in the bond market, in other words, rise in bond yields, and that's typically met with some weakness in equities. Having said that, it's important to emphasize 3 things. First of all, real rates remain very negative. And that's pushing people up the risk curve into real assets, things that can grow with nominal GDP, like equities, and that's providing some support. Secondly, valuations have come down a long way. Most equity markets, at least outside of the US, have lower valuations than long-term averages now. And thirdly, we should recognize that private sector balance sheets are strong. Households have got reasonable savings, but banks and also the corporate sector have positive cash flow. They've got strong balance sheets, so they can withstand some degree of economic slowdown. I think there will come a point, though, where rising nominal rates push up real rates and we'll start to get some further vulnerability in equities. And that's really the thing to be watching for, I think.
Hey guys, it's Jose, your regular Joe Blow again, keeping an eye out and my ears open to continue to learn, prosper, prepare, so we can continue to enjoy our God-given freedoms. Remember, I work for you guys, and I want to bring as much awareness and clarity as possible to better serve you. Let's continue on this journey together. Thank you guys as always. I appreciate your time. Stay free.
It ain't hard to tell. I excel, then prevail.